Bitcoin has shattered expectations once again, defying skeptics and thrilling investors worldwide. It has surged past the significant $100,000 mark, a milestone that seemed almost impossible just a few years ago. This milestone has sent ripples through the financial world, capturing the attention of both seasoned investors and newcomers alike. Is this the dawn of a new era for Bitcoin? Many believe that this could be the beginning of a transformative period for digital currencies. Or are we on the precipice of a dramatic fall? The volatility of Bitcoin has always been a double-edged sword, offering both incredible gains and potential losses. Several factors have propelled Bitcoin's recent surge, creating a perfect storm of conditions that have driven its price to new heights. Institutional investors, once wary, are now entering the market with significant capital. Their involvement has brought a new level of credibility and stability to Bitcoin. This influx of institutional money has legitimized Bitcoin in the eyes of many, transforming it from a fringe asset to a mainstream investment. Regulatory clarity, though still evolving, has also played a role. Governments and financial institutions are beginning to establish frameworks that provide more security for investors. Governments worldwide are beginning to grapple with Bitcoin and other cryptocurrencies, recognizing their potential and the need for regulation. Clearer regulations provide a more stable environment for investors, reducing the uncertainty that has often plagued the cryptocurrency market. This increased stability can foster greater confidence in the market, encouraging more people to invest in Bitcoin and other digital assets. Finally, Bitcoin's performance after previous U.S. presidential elections cannot be ignored. Historical data shows a pattern of gains following these elections. Historically, Bitcoin has seen gains following these elections, suggesting that political stability in the U.S. can have a positive impact on its price. This trend, combined with the other factors, has created a perfect storm for Bitcoin's price surge. As we move forward, the question remains: will Bitcoin continue to rise, or will it face new challenges that could halt its progress? The current Bitcoin rally is markedly different from previous bull runs. Unlike the speculative frenzy of the past, this surge is underpinned by a more solid foundation. Institutional investment is a key differentiator this time around. Large financial institutions and corporations are now entering the market, bringing with them a level of credibility and stability that was previously absent. Major players in the financial world, such as Tesla and MicroStrategy, have added Bitcoin to their balance sheets. This move has not only validated Bitcoin as a legitimate asset, but has also encouraged other companies to consider similar strategies. These companies view Bitcoin as a hedge against inflation. With central banks around the world printing money at unprecedented rates, the fear of devaluation of traditional currencies is driving this trend. They see it as a store of value in an increasingly uncertain economic landscape. Much like gold, Bitcoin is being perceived as a safe haven asset that can protect wealth from the volatility of traditional markets. This institutional adoption has brought a new level of maturity to the Bitcoin market. The involvement of seasoned investors and financial experts has led to more sophisticated trading strategies and risk management practices. Hedge funds and asset management firms are also joining the fray. These entities are not just buying Bitcoin, they are integrating it into their broader investment portfolios, further legitimizing its role in the financial ecosystem. They are launching Bitcoin-focused funds and investment products. This has opened up new avenues for investors who may not want to hold Bitcoin directly, but still want exposure to its potential gains. This influx of institutional money is providing significant upward pressure on Bitcoin's price. The sheer volume of capital entering the market is creating a supply-demand imbalance that is driving prices higher. It's not just institutional investors driving this rally. Retail investors too are playing a crucial role in this unprecedented surge. Retail investors, fueled by social media and FOMO, or fear of missing out, are also pouring money into Bitcoin. Platforms like Twitter, Reddit, and YouTube are buzzing with discussions, tips, and predictions, creating a viral effect that amplifies retail participation. This combination of institutional and retail demand has created a potent force driving Bitcoin's price ever higher. The synergy between these two groups is unprecedented, making this rally one of the most significant in Bitcoin's history. While institutional investment is generally seen as a positive sign, some experts are sounding the alarm. One such voice is R. Paul, a prominent investor and Bitcoin analyst. He expresses deep concerns about MicroStrategy's aggressive Bitcoin strategy. MicroStrategy, a business intelligence firm, has bet heavily on Bitcoin. They have accumulated a massive Bitcoin reserve, purchased with company funds and through debt. This strategy has raised eyebrows in the financial world. R. Paul argues that MicroStrategy's increasing cost basis is a cause for concern. The company has consistently bought Bitcoin at higher and higher prices. This strategy works well in a bull market. However, if the market reverses, MicroStrategy could face significant losses. R. Paul also highlights the systemic leverage embedded in MicroStrategy's approach. The company's large Bitcoin holdings create arbitrage opportunities for other traders. This leverage, often hidden, can amplify losses if the market turns south. Leverage in financial markets is a double-edged sword. It can magnify profits in a bull market. However, it can just as easily exacerbate losses during a downturn. The Bitcoin market is no stranger to leverage. The availability of 2 times leveraged MicroStrategy ETFs is a case in point. These exchange-traded funds allow investors to double down on MicroStrategy's Bitcoin bet. While this can lead to outsized gains in a rising market, it also amplifies potential losses. A sudden drop in Bitcoin's price could trigger a cascade of selling in these leveraged ETFs. This selling pressure could further depress Bitcoin's price, creating a vicious cycle. This scenario is not without precedent. The collapse of Three Arrows Capital, a crypto hedge fund, is a stark reminder of the dangers of excessive leverage. The fund's implosion, triggered by a sharp decline in crypto prices, sent shockwaves through the industry. Section 5. The Ghost of 75% Crashes. A looming threat? Bitcoin is notorious for its volatility. This digital currency, often hailed as the future of finance, has a history that is as tumultuous as it is fascinating. Investors and traders alike have witnessed its price swing wildly, sometimes within mere hours. This inherent volatility is both a boon and a bane, attracting speculative traders while scaring off more conservative investors. Over its relatively short history, Bitcoin has experienced several boom and bust cycles. These cycles are not just minor fluctuations but significant events that have shaped the market's perception of Bitcoin. Each boom brings with it a wave of optimism, with headlines proclaiming Bitcoin as the new gold. Conversely, each bust brings a wave of skepticism, with critics quick to declare the end of Bitcoin. These cycles are often characterized by meteoric price rises followed by dramatic crashes. The rapid ascent in price can be attributed to a surge in demand, often driven by media hype and speculative buying. However, this is usually followed by an equally rapid descent as the market corrects itself, leading to significant financial losses for those who bought in at the peak. One of the most striking patterns in Bitcoin's price history is the tendency for 75% corrections. These corrections are not just random events but seem to be a recurring theme in Bitcoin's life cycle. Each major correction has served as a stark reminder of the risks involved in investing in such a volatile asset. These corrections, while painful, are viewed by some as a natural part of Bitcoin's price discovery process. They argue that these corrections help to stabilize the market in the long run, weeding out speculative excesses and bringing the price closer to its true value. However, this perspective is not universally accepted and the debate continues. However, R. Paul argues that the absence of a significant correction in the current bull run is a red flag. He believes that the market's failure to correct itself could be indicative of underlying issues that are not immediately apparent. This lack of correction could be masking deeper problems that could lead to a more severe crash in the future. He suggests that this lack of a correction could lead to complacency among investors. When investors become complacent, they are more likely to take on excessive risk, believing that the market will continue to rise indefinitely. This mindset can create a bubble, which, when it bursts, can lead to catastrophic financial losses. It might also create conditions for an even larger crash down the line. The longer the market goes without a correction, the more severe the eventual crash could be. This is because the market becomes increasingly overvalued, and when the correction finally comes, it has a lot of ground to cover to return to a more sustainable level. While a 75% crash is not a certainty, it is a possibility that investors should be prepared for. Being aware of this potential risk can help investors make more informed decisions and avoid the pitfalls of complacency. Diversifying investments and setting stop-loss orders are just a couple of strategies that can help mitigate this risk. The history of Bitcoin is replete with examples of unexpected price swings. These swings can be triggered by a variety of factors, including regulatory news, technological advancements, and macroeconomic trends. Understanding these triggers can help investors better navigate the volatile landscape of Bitcoin investing. Ignoring this historical context could be a costly mistake. Investors who fail to learn from the past are doomed to repeat it. By studying Bitcoin's history, investors can gain valuable insights into its future behavior and make more informed investment decisions. In the world of Bitcoin investing, risk management is crucial. It's not just about making profits, but also about protecting your investments from potential losses. Strategies such as diversification, setting stop-loss orders, and regularly reviewing your portfolio can help mitigate risks. A prudent investor always has a shield against market volatility. This involves staying informed about market trends, understanding the underlying technology, and being prepared for sudden market shifts. Remember, knowledge and preparation are your best defenses. Hedging is an essential tactic to safeguard against the unpredictable nature of Bitcoin. By using financial instruments like options and futures, investors can protect their portfolios from adverse price movements. It's all about creating a buffer to weather the storm. Investing in Bitcoin is a balancing act between risk and reward. While the potential for high returns is enticing, it's important to weigh this against the inherent risks. A well-thought-out strategy, grounded in research and risk management, can help you navigate this dynamic landscape.